The market is either too high to buy or too low to hold, and somehow it's always the wrong time. That cycle of dread is not a glitch in your brain. It is the feature that Wall Street has been quietly exploiting for decades. Here is the uncomfortable truth. The very moment you feel most confident about getting out is usually the moment you should be staying in. We have built entire industries around the illusion that timing the market is a skill when the data keeps telling us it is mostly just expensive anxiety. Think about what actually happened to investors who bought right at the peak of some of the worst looking moments in modern market history. They still ended up ahead within a year or two. A double-digit drop feels like the floor is falling out, but historically it is closer to a Tuesday. The S&P 500 has averaged an intra-year drawdown of roughly 14%, meaning the pullbacks we are white-knuckling through right now are not anomalies, they are the schedule. We panic about normal like it is catastrophic, and that panic is precisely what turns a temporary dip into a permanent loss. There is a reason behavioral economists call this the peak end rule. We judge experiences by their worst moments, not their overall trajectory. So even a portfolio that tripled over 10 years feels traumatic if there were 2 brutal winters along the way. Now here is the part nobody puts in the brochure. The actual journey to financial goals is uncomfortable, boring, and occasionally terrifying. The smooth compound growth chart your advisor showed you was drawn with a ruler. Real life is drawn by a toddler with a crayon during an earthquake. And yet, here is what we know with near certainty: corporate earnings drive equity prices over the long run, full stop. Geopolitical chaos, rate hikes, election cycles, these are the weather, and earnings are the climate. People ask us constantly, should I wait for things to calm down before investing? And our honest answer is that things have never been calm, not once in recorded financial history. There has always been a reason to wait, and the people who waited are still waiting while the market quietly doubled. The misconception we need to kill right now is that patience is passive. It is actually the most aggressive strategy available to a retail investor. Doing nothing while your brain screams at you to act is one of the hardest and highest returning moves in finance. History gives us the lesson on a silver platter. The investors who missed just the 10 best days in the market over a 20-year period cut their returns nearly in half. 10 days out of roughly 5,000 trading sessions, and your entire outcome shifts dramatically. So the practical move is boring, and that is the point. Automate contributions, diversify broadly, size your positions so a bad month does not make you irrational, and stop checking your portfolio like it owes you an apology. Discipline is not a personality trait here, it is a system. And systems beat feelings every single time. At the philosophical level, the goal is not to feel good about your investments, it is to build a process so sound that your feelings become irrelevant to the outcome. Comfort with uncertainty is not recklessness. It is the graduate level skill that separates wealth builders from wealth warriors. We can be completely honest. We do not know if the market drops another 10% next month, and neither does anyone on television. What we do know is that the earnings engine underneath this economy is still running. And historically, that is what pulls prices higher, regardless of the noise above it. So prepare rationally, size responsibly, and let the process do the heavy lifting while everyone else is busy being dramatic about headlines. The goal was never a perfect entry point. It was always just staying in the game long enough to win. And if you want help getting into the game through real estate investing, connecting with lenders, or finding trusted contractors, check out our links in the description below.